Hello, my friends. Today is May 11th, and this is Markets Weekly. So, this week was a good week in markets. We ended the week up nicely. And it looks like we're just a little bit below all time highs. I'm guessing that when we finally close above all time highs, a lot of the bears will have to cover, and that will fuel the next leg up. But let's see how that turns out. So, today I want to talk about three things. First, I want to talk about this super interesting article in Bloomberg about the per capita recession, where on a national level, it looks like GDP is growing, but when you break it down on a per capita level, for many countries, GDP has been declining for a few quarters. Secondly, I want to continue and talk about the ongoing global rate cut cycle we're in, where we had a new entrant, Sweden, cut rates last week, and it looks like the Bank of England, at their most recent meeting the past week, strongly suggested that they're going to cut rates soon as well. And lastly, I want to talk about this very interesting report from the IMF that suggests that although on the surface, it looks like there isn't really any decoupling in global trade, when you look beneath the surface, there are signs that the world is bifurcating into a more pro-US bloc, a more pro-China bloc, and some people who are in between. And that seems to be impacting things such as foreign reserves and, of course, the demand for safe assets. Okay, let's start with the per capita GDP recession. Now, let's level set a little bit first. So, what is GDP? GDP is just basically the amount of goods and services produced in a country in a year. So, in order to increase GDP, you can either have more inputs or you can have more productivity. That is to say, get more output for the same level of inputs. Let's look at a car factory as an example. Let's say I have a car factory where I use 10 tons of steel and create 100 cars. If I wanted to make more cars, what I could do is I could just use more steel. Maybe I would use 11 tons of steel and get 110 cars. Or maybe I upgrade my technology, whereas with the same 10 tons of steel, I get 110 cars. Now, over the past few years, of course, we've had some increases in productivity. Obviously, technology is improving, but for a lot of countries, GDP growth has been fueled by increases in people, more migration, more inputs. Now, looking at, say, Canada, Australia, the UK, and even in the US, migration over the past few years has notably increased. Canada, in particular, the last year looks like they increased their population by 2.5%, are running a mass migration experiment that no one else in the world is coming close to matching. Now, if you add a lot of people into your country, obviously you have more workers, you're going to be producing more goods and services. It looks like your GDP is growing. But on a per capita basis, it's telling a very different story. Now, on a per capita basis, it looks like for these countries, GDP per capita has been declining for at least a couple quarters. And that means that the living standards of the average person is not being accurately represented in these national GDP data because even though GDP is growing, on a personal basis, they're not doing as well. Now, migration has many economic impacts. As you add more people, you get more GDP growth. You also put downward pressure on wages, which many people in government who are concerned about inflation would like to see. But you also put upward pressure on other things. For example, when people move to a country, obviously they need housing, they need healthcare, they need schools, and so forth. And the supply of those things are relatively inelastic over a short period of time. It takes time to build a house. You need a lot of permits, for example. It takes time to train doctors, takes time to train school teachers, and so forth. And what we've seen in many of these countries is that even as migration has put downward pressure on real wages, it's put upward pressure on things like house prices. So in Canada, for example, you can see in this chart, real wages haven't grown all that much over the past few years, but house prices in real terms have gone to the moon. You can see to some extent this happening in New Zealand and Australia as well. So what's been happening in these countries has really hurt the living standards of the normal person, where mass migration decreased their wages, made their housing and rent more expensive, made their schools more crowded, and of course made them have to wait even longer to see a doctor. Now, in the US, the past year, we had also significant amounts of migration. The CBO estimating it about 3 million. Most of it is illegal, so we don't really know for sure, but it's happening to a much smaller extent. And the US is a large country, so it hasn't been felt as much in the US as well. Although, if you look at New York City, for example, which has been a big destination for migrants, vacancy rates there are at multi-decade lows, and so rents are going to the roof as well. So the policies run by these governments, on the surface, looks like they're boosting GDP, but actually have not been helping their people. Now, as a counterexample, I would point to Japan, which, as we all know, is famously not open to migration. Now, over the past few decades, the GDP growth of Japan has been growing slower than other countries. No surprise. Their population has been shrinking. And if you have fewer people, obviously you're not going to be able to produce as many goods and services. And also, you don't need as many goods and services, obviously. Now, over the past few decades, what you can also see is that GDP per capita in Japan has actually continued to go up, trend higher. And so, the people there seem to be fine. Looking at housing prices, what's really surprising when compared to many Western countries is that on a real basis, housing prices in Japan really haven't gone anywhere over the past few decades. Part of that is due to a bust in the 1980s where they had a big property bubble, but part of it also is due to their decreasing population, less demand for housing. So obviously rents don't go up as well. So I would think that their living standards for the typical person there has actually been fine. And if you ever go there, you'll notice that they have a very safe and cohesive country simply because it's so homogenous. And so people there seem to be doing quite well, and it seems like a great place to live. So their government did different policies, and I think that it made their country better. And hopefully, I think many other governments will become aware of this. What I see is that there is, I guess, more backlash about some of these large migration policies run by Western governments. I know in Canada, for example, Prime Minister Trudeau is talking about reducing the amount of foreign students. So again, not that migration is bad, but you can have too much of it, and that would hurt the native population, which is already happening over the past few quarters. Okay, the next thing that I want to talk about is the ongoing global rate cut cycle. So, as we've talked about before, the Swiss National Bank kicked off the global rate cut cycle a few weeks ago simply because inflation had gone down significantly and there was no reason for them to keep rates where they were. Now, a new entrant this past week is Sweden. Now, Sweden, as you can see here, inflation has also been coming down significantly. So the Riksbank, the Swiss central bank over there, realized that they really didn't need to keep inflation, did not need to keep rates where it was and cut rates. Now, something interesting to note about Sweden is that their mortgages there are mostly short-term. And so because their mortgages are short-term, as people renew their mortgages every few years, they get hit by higher interest rates really quickly. So the monetary policy there is much more effective than it would be in a country like US where everyone has 30-year mortgages. And so as more and more people renew their mortgages, their interest rate payments gone up. And so they began to feel the squeeze. And maybe that made the Riksbank's job a bit easier. Now, similarly, the Bank of England the past week also strongly suggested that they're going to be cutting rates soon as well. Now, their monetary policy decision left rates unchanged, but there were two dissents wanting to cut rates. Now, when you look at data in the UK, it becomes clear that it would make sense for them to begin to cut rates. On the one hand, you do see unemployment rising. On the other hand, it does seem like inflation is coming down towards their target. It's been steadily coming down and now is even below that of the US. Now, the UK, like Sweden, is also a country where a lot of the mortgages are short-dated. So I think that in these countries, you can definitely have monetary policy become more effective, higher interest rates quickly squeezing households, and thus tamping down on demand, getting inflation under control. You can this structure is also what you see in Australia and Canada and parts of the European Union as well. So I think it's no surprise that you can also see that the ECB is also strongly suggesting that they're going to cut rates in June as well. Now, the Bank of England, now Governor Bailey, keeping open the door for a June cut, but not fully committed to it. And I think that the market is pricing in cuts a little bit after June. So what's really interesting happening right now is that although on the way up, we were all kind of on the same boat trying to get inflation down, now that we've been holding rates relatively high for over a year, we're beginning to see more of a divergence in the stance of monetary policy across the advanced economies, in part because, well, monetary policy is more effective in these countries that have more floating rate mortgages and less fiscal spending. So it seems like we're heading into a world where the Fed is going to be keeping rates higher than other people, and that's leading to a bit of dollar strength. Now, it's hard to see how long this will continue, but we do see this in the market pricing over the past few months. And if the Fed really does stick to their guns and just really keep cutting rates less than other people, then I can see the dollar continue to strengthen going forward. Although, as I've discussed before, I'm not sure if the Fed can really hold out as long as the market thinks it will. Okay, the last thing I want to talk about is this really interesting paper from the IMF talking about global decoupling. So as we all know, over the past few years, starting with President Trump's trade wars on China, there's been a movement to friendshore and try to bifurcate the world between, let's say, US, Europe, Western bloc, and a bloc that's more China-friendly, be that China, Russia, North Korea, some countries in the Middle East, and so forth. But when you look at the aggregate trade data, it's not super clear because global trade seems to be doing quite well. Now, some scholars at the IMF looked into this in a different way. So they looked at voting data in the United Nations to try to parcel out countries into blocks, some blocks that are more China-friendly and some blocks that are more US-friendly. And based on these blocks, what they're finding is that there actually has been some rewiring in global trade and global finance. So it seems like what's happening is that the world is being divided into three blocks: pro-China, pro-US, and countries that are non-aligned. Now, there seems to definitely be less trade between the pro-US bloc and the pro-China bloc. But you don't see that in aggregate statistics because trade is actually happening through these third non-aligned blocks. So, for example, instead of a Chinese company selling directly to the US, what they would do is they could sell to a non-aligned country like Vietnam, and then Vietnam would turn around and sell to the US. So global trade continues to happen, but it's going through, I guess, longer channels now. These non-aligned blocks are benefiting from some degree of this polarization in the world. Now, when it comes to these financial channels, I think it's really interesting to note that financially speaking, these pro-China countries really are moving away from the dollar and trying to use more and more RMB. So again, this is happening at a small scale, but it's definitely happening. So what we could see is maybe the beginning, again, early stages of a beginning of some kind of a segmentation in global finance. Another interesting to note is, of course, these countries that are in the pro-China bloc, obviously worried about US sanctions, have been buying more gold. And that might be part of the reason gold has been well bid. And that's what I'm going to write about in my blog today, how I think that, I think things are going to be quite good for gold going forward. Now, one thing to note, though, when we think about these tensions between China and the US, is that it's really hard to have a sudden delinkages. Everyone is hedging, but it's quite hard to have sudden delinkages. Now, Brad Setzer, who is an expert on these topics, had a really good paper on this just recently published, and he charts out how China has actually for some time been aware of their vulnerabilities to U.S. sanctions. It wasn't something that suddenly they realized after what happened with Russia. Now, even as early as the Great Financial Crisis, China was very worried that they would be losing a lot of money on their large investments in agency mortgage-backed securities. For them, it was in part worrying about, it wasn't so much about sanctions, although that was always a possibility. For them, it seemed to be a domestic political concern, whereas the government is seen basically funding bad policies in the U.S. and potentially losing money in case let's say they lose value on their agency MBS or their treasury securities. And so there's been a big effort for them to diversify over the past decade, and they've been doing this by lending money to a lot of other countries. For example, China created all these development banks, and right now it looks like these development banks have lent over $1 trillion to countries, say in Africa or other developing countries, to basically, in part, build relationships, have more influence over the politics of those countries, but in part to diversify their tremendous amounts of dollars outside of U.S. treasuries, outside of U.S. agency MBS, and into these bilateral loans. And some of them are multilateral as well. But I think what they've learned is that they have less power when the loan is multilateral. So this diversification thing has been happening for some time, but it's also something that it's unlikely to suddenly, I think, to break down, because Brad also makes a point that let's say that one day China invades Taiwan and the US turns around and freezes all of China's dollars. Again, that would be really catastrophic for China. But on the flip side, there's also a strong dependence of the US on China. You would basically overnight lose all your cell phones. And I think the US, the American public, would not like suddenly losing access to new cell phones, because all that stuff is in some way either assembled in China or there are a lot of components made there. So this mutual dependence is real, and it also makes it less likely for there to be sudden disruptions between the two countries. That being said, they also have to hedge. The US is building more chip factories, and then China is diversifying outside of US assets. So anyway, that's all I prepared for today. If you're interested in hearing my thoughts, be sure to check out my blog at fedguy.com. And if you're interested in learning more about markets, check out my online courses at centralbanking101.com. I'll talk to you guys next week.